Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, June 2nd, 5:10 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at key levels for next week, and update the world famous 21 over 21 leaders list. Let's get right into it. State of the market. We're in an uptrend led by large caps, primarily large cap tech, but some broad rotation taking place today into cyclicals, into some of the more beaten down areas that have taken a step back, while generative AI related stocks like semiconductors and software and the big FANG type tech stocks have taken a step forward. We saw some rotation today, and it was on the back of some economic data that we'll get to when we get to the tail of the tape. But all in all, a really good close to the week for the market. Even the supposedly weak KRE sector, that's the ETF for regional banks, had a great day today. And it's more important when you have a day of weakness in a sector like you did yesterday on some supposed bad news, negative commentary from the FDIC, but to follow it back up with recovering all the losses and then some. That's a good sign today. So we're uh, looking next week at, hopefully we can just have uptrend on here and no qualifications. We need some additional follow through from the sectors that saw some rotation into them today, and even a little sideways action would be fine. We'll get all into it and more. First, let's check the trend gauge over here. We've got leaders in an uptrend, acting well. In fact, only one falling off the 21 over 21 lead. I technically could have kept them all on, but I made a couple of changes, and I'll talk about why I made the changes when we go through the charts. But in an uptrend, leaders participating, acting well. Short term, we have nothing showing in bearish downtrend anymore for any of the 5 indexes, because they all made a nice step in the direction. We want to see multiple closes above key moving averages, so we've got them listed as neutral here now, as you can see. Short term, still in an uptrend. uh, Dow, mid caps and small caps trying to join that at least 2 closes above the 21 group. To the 50-day moving average, uh, all 3 of the laggards, the Dow, mid caps, and small caps, now on neutral also. Long term, referencing the 200-day moving average, a blast above today. Again, we need to see more strength for mid and small caps, but definitely a step in the right direction for the overall market. So what happened today? A gap up, woke up to a gap up. And when I first got up, this was before the 8:30 jobs report. The S&P was up about 0.4%. Then the jobs report hit, and it was a mixed bag. It was good from the standpoint that if you're looking for a job anyway, more jobs created than was forecasted. Now, ordinarily, this months ago, this would have been bad news, because the market has been wanting the Fed to stop hiking. But there were 2 pieces of data in there. The unemployment rate ticked up. This is due to participation, and the average hourly earnings fell, which is good because it keeps inflation under control. So you got kind of mixed messages on the inflation, but the market, I think, is as concerned, or probably more concerned more now, about the recession and a possible soft landing. So that's my interpretation. You honestly don't need an interpretation or opinion. We try to set them aside. I know everybody feels good when there's an explanation for something, and I'm among that group. But that's the official Wall Street story on today's action, and that action was bullish, and rotation out of, you can see the Nasdaq 100, the weakest sector on the day. Semiconductors took a break. Some of the recent AI type leaders took a break. So you can see that was up the least today. Here are the final numbers. RG8, this is our 8 growth ETF composite. up 2.4%. So despite rotation into cyclicals, growth stocks still had a nice performance on the day. S&P 500 up 1.45%, Nasdaq 100, the laggard, haven't said that in a while, up 0.75. The Dow, which has been the laggard, led the way for the big cap indexes today, up 2.1%. Now here's where what we really like: mid caps and small caps up 3.3 and 3.6% respectively. These are the sectors that have been beaten down, dragged down by the liquidity issues in regional banks, and oils also having a bad year. But they led the way today, blasted above some resistance and some moving averages, and it was definitely a good sign for the market today. Global 60/40 stock and bond up 0.73%. Bond prices down across the board. That means yields up a little bit, but that's why that lagged market didn't care. The market liked it, as you can see from the green on the screen. In-house GROTECTION up 1.2%. Some of our leaders that we own lagged today. A couple other ones were standouts like Uber, DT, and Tesla. All in all, a good day and wrapping up a good week. We're pretty pleased with the performance. We'll get to the tail of the tape and the updated 21 over 21 list. Let's get right into it. Here's the S&P 500, and you can see very clearly the gap up, separating itself, closing at the top of the range on the day. Nothing bearish about this in any way, shape, or form. In fact, one of the last bearish arguments today, which was lack of breadth, was swept away with the sector rotation and the rally in mid and small caps. So the next resistance areas that we're looking at on the S&P 500 is the round number 4,300, the 4,325 high from last August, and sandwiched in between there is a level that's a fib level, retracement of the bear market at 4,312. So we've got three key levels there, all within 25 points just overhead. Wouldn't be surprised if we see a little bit of a pause there, but that's fine. We're now 2.7% above the 21-day moving average. That's a little stretched. And 3.9% above the 50-day. That's not bad. I really like the angle of ascent of these. Remember when I did the video last week, I highlighted those two numbers and why I liked them, and what they were was where the 21 and the 50-day were, and how they were crucial to containing any pullbacks, and how they were relative to recent support. And they just keep moving higher, and that's good. You know how we operate at Revere. When we start breaking short-term or medium-term levels, we get more defensive. Seeing these levels at a higher print is a good thing. It means if we have to pull the plug on where we are in the market, we're getting out higher than we got in, locking in gains. And of course, we continue to put distance between the indexes and the flat 200-day moving average, now 7.7% above the 200-day moving average on the S&P 500. Let's move over to the current leading sector that was lagged today, despite the fact that it made a higher high for the recovery, including a higher closing high. The Nasdaq 100 up 0.75%. You can see this is extremely extended to the upside, 9.5% above the 50-day moving average. We still have our SQQQ short on. It doesn't make sense to take it off when you're this extended. We know about reversion to the mean, where it's losing, but it's offsetting a bunch of the gains that we're making. It kept us from selling some things while we were getting defensive earlier in the week while the market was struggling. So NASDAQ 100 continues to look strong, but in a positive sign, less strong than this index today, the Dow Jones Industrial Average. We were real happy that it held multiple tests of the 200-day moving average this week and last week, and look at that blast off today. And the big high ticket items, high price stocks that had been pulling this down had great days also. A hookup in the 21-day moving average, bouncing strongly off the 200, back above the 21, back above the 50, and approaching that 34,000 level, which have been resistance going back to April. So again, a little bit after two strong days up on that, a little bit of sideways movement would be just fine. You can see another big breakout here on mid caps. I talked about this 450 level that we wanted to get back above it. As if the market was listening to me, it did it and put a smile on the bulls' faces above all of the key moving averages, which were stacked up there and serving as resistance. Now, if we pull back, we just want to hold this 450 level and treat it as a launching pad to higher prices. 461-ish, 460 to 461 resistance over here from late March and early April. That's the next level to clear. Let's go to small caps IWM. Beautiful candle here. Again, the stacked moving averages here around the 8 to 21 and the 50 had been acting as resistance. The 200 acted as resistance when small caps tried to rally at the end of May. 523 we rejected there. We got up to 180 when we were recording the podcast today, and I commented on it while we were recording that. Blasted 2 points higher into the close, another percent, closing at 182. Great stuff here. Again, wouldn't be surprised to see a pullback. Any pullback should hold this 179 to 180 level, which is where the 200-day moving average is. Definite good signs, definite broadening participation, and also participation among the mid and small caps, which we hadn't seen in a while. Trying to recover from this area here, which was the big uh, move down that we had on the regional banking liquidity fears. In fact, filling the gap of this first move down on 3.9, which is when the nonsense started to happen in the first place. So good stuff there, breaking through the top of this big base that was set. And nothing bearish about that. The bears are running out of ideas. Let's go to the VIX now. Bears aren't believing this either. Look at this clean break back below, corresponding with a clean break in the S&P 500 out of its base, breaking below the 15 level. Haven't seen that in over a year. Down 6.7% for the VIX. The dollar today, dollar was strong. Market didn't care. Back above the 200-day moving average after this spin out yesterday. This is bad print, hasn't been fixed. I really don't know what happened here, but we really ended up yesterday closing tight below the 200-day moving average and back above it today. So dollar strength continues, but the market is shaking it off. Let's go to how the sector, let's go to precious metals here. Here's gold, strong dollar. What's the correlation? The correlation, except for one day this week, is negative, and we saw it again. So basically for now, this 4-day rally that we saw on gold off of this 180 level, we took back 3 days of that in one day, down 1.5%. Gold bulls disappointed again. Note relative strength, making a lower low ahead of price is bearish. GDX, gold stocks, based a little bit longer around this 30 area, 2 days up, gave back about half of it, failing at the 21. Uh, Not as bad on a relative strength basis as the barbaric metal is, but still, uh, if you're a gold stock bull, you need to get above the highs of the last 2 days, above the 21-day moving average, and certainly hold this 30 level on any pullback. Finally, silver down 1.18% today, failed into the 21-day moving average also. Let's flip to bonds now. Bond prices down across the board today after a 4-day rally up. Ran into the declining 21-day moving average and failed back below the 200-day. Gave back about half of the rally over those 4 days. So back to the bottom of the range, back toward the bottom of range for bond prices. That means bond yields higher, which we'll see in a minute. Here's TLT giving back about a third of the rally over the last 4 days. 30-year yield inverse correlation to TLT. 4-day pullback, 1 day up, back above the 21-day moving average. And this looks like the top of this former intermediate range that it set. That's where we bounced yesterday. So that's the support area on the yield, and conversely, the resistance area on the price. TNX, the 10-year yield, bounced after 4 days down off the 200-day and 21-day moving averages. Finally, Bitcoin up 1.8% today, a laggard. Relative strength at lows before price. Again, that's bearish. No reason to be in Bitcoin for the way I see it anyway. Um, oh yeah, RSP, the equal weighteds. Again, talking about the broad strength, RSP. Look at this, breaking a downtrend line, outperformed, up 2.2%, outperformed the market cap weighted S&P 500. Again, this is good stuff. It means more stocks are participating, and again, it's throwing cold water on the bulls or the bears case. There's RSP, QQEW, equal weighted tech, breaking out higher high above this really nice base, equal weighted tech up 1.1% versus 0.75% for the market cap weighted. So the positive news continues. What do the bears have left? I don't know. Here's the tail of the tape. All the stochastics looking positive. The dollar market's shaking it off. We're more mid-range now on bonds. VIX below 15. Some news: Senate passed the debt ceiling bill, so Biden's going to sign it. That's all in the rearview mirror. Strong NFP report, but average hourly earnings down, so a little bit of a mixed bag, but the market liked it. And China talking about a stimulus. Uh, like steel stocks, copper stocks, anything that you drop on your foot and it can hurt, those stocks rallied today. And again, that lends into the broad market participation and flies in the face of the recession. Day count up 4 of the last 6, fifth day above the 80 EMA, sixth day above the 21 EMA, getting a little bit stretched on the 21, but we've historically gone higher. If you get more than 3% above the 21, it's a mild cause for concern. Sorry, 4% above the 21, we're at 2.7%. FOMC rates of a 25 chances of a 25 basis point hike kicked up to 30% today. Our expectations remain positive and even more positive now with the broad participation today. You can see, let's do the S&P 500 very quickly on a 5-minute chart here so you can see the way the day progressed. Kind of look how yesterday where we went down, we had we opened basically flat, sold off early, and then rallied. Today gapped up, quickly made a higher high, sold off. Uh, Cause for concern, not at all. Rallying, uh, bulls came in every time we tried to pull back today. Rally up to 4280, form a little 70-minute base, go higher, make a higher high, 4286, pull back, hold the 4280 breakout level, 4278 plus or minus 2 points, no big deal. Rally up to 4291, a little bit of a fade into the close. Nothing wrong with that action today. Back to the tail of the tape. 11 out of 11 sectors up. The only one that was weak, that stood out as weakness, was XLC, and that's because Amazon supposedly said they were going to borrow spectrum from the big cell phone providers and create a cell phone service. If you own Amazon Prime, and T-Mobile, Verizon, and AT&T all sold off. T-Mobile was hit the worst, but it rallied to only be down 5.5% after being down almost 6, 7, about 10% on the day. Looks like a panic move. Um, and Amazon, and actually Amazon came out after the close and said, we have no current plans to do that. Amazon gapped up, reversed, but still made higher highs. So that's the reason why XLC was weak on the day. The communication sector, that's where the cell companies reside. Builders strong, oil strong, pick strong. That is base metal miners, KRE, regional banks strong, BINF, that's basic materials, industrials, and financial strong, jet strong. Anything that would benefit from a strengthening economy was up today. On the downside, gold and silver stocks, and semiconductors taking a break. Other than that, it was just bonds in the red. No changes to the portfolio today. These are our holdings in order of, first it's the ETFs, and then in order of uh, size. Bottom line for the week, bulls follow through with a broad rally and sector rotation, also market cap rotation, as we got some nice participation out of mid caps and small caps. And now let's hit the 21 over 21. So I said I made some changes. The only stock that was borderline that got kicked out was Shopify. Uh, and look at the relative strength line on Shopify. It undercut yesterday, reclaimed the 21, stay of execution, maybe. No, I didn't give it one. Gapped up, sold off during the day, held the 21. But something that has relative strength that looks like this doesn't belong in my leaders list. Now, yeah, it held the 21, and I might end up seeing the same issue that we saw with Celsius, that it just comes down to 21 and rallies, or with DraftKings that did the same thing. But neither of them had relative weakness the way Shopify is showing. And that got punted. The other two that got punted were two sector ETFs. They were kind of placeholders because of all the big IGV for software. All the big software companies continue to rally. That's still the case. Uh, Same thing with semiconductors. Semis rallying very clearly, the leading sector right now, although it did base on the week. But we talked about this in the podcast. We've been evaluating AI ETFs and replaced these two with the one that we bought this weekend. It's called Chat. It's very new, but I like the composition of it the best of all the other ones that are out there. And if you want to learn more about that, tune in to the podcast, which is already out on YouTube. And if you're on the email list, a link will be emailed to you tomorrow. So IGV off, socks off, chat on, shop off, Google added, which we bought this week. One of the big seven, very much a leader, acting fine, putting in a little week and a half base here after its gap up and on earnings or after earnings, and it's pulled back to 120 where it bounced. And the second one that's being added, or the third one, Chat was the first one, Google the second one, Palo Alto is being added. Very security had money flowing into it today. It's playing a key role as in AI, and Palo Alto is the leader there. Let's go to the 21 over 21 list. You can see Palo Alto there. I showed Chat. I showed Google. Let's go to the rest that are carrying over from last week. If it has a red flag next to it, we own it in-house. We'll start off with Monday.com, continues to trend higher along the ADMA, a breakout this week, pulled back today. Toll Brothers, Builders had a fantastic day, this one breaking the higher highs. Tesla, we added to our position this week and it broke out. Got back above the 200-day moving average, held on the pullback just like you want to see. Palantir continues to base for 4 days here now after a big move up after its earnings and part of the AI group. Live Nation pulled back, bounced at the 21, back above the ADMA, 80 level support, looking good. Dynatrace, one of our top three positions, continues to just quietly trudge higher, showing relative strength, riding the ADMA higher. If they all acted like that, my job would be a lot easier. ELF, move up, gap up on earnings, not giving any of that back. The 100 level now providing support as well as the ADMA. Chipotle going sideways, stalling a little bit. You can see relative weakness toward the end of the week. We're keeping an eye on that as the restaurants aren't acting as well as they had been prior. Uh, this is actually becoming more, look how it's just gone sideways. We want to see more relative strength out of this. Nothing wrong with it, but we want our stocks to perform 2 times what the S&P is doing. And Chipotle, as of right now, is not. AMD continues to be strong after its big move up, consolidating, pulling back. The ADMA providing support for it the last 2 days. Supermicro continues to be a super performer. A little bit of a pullback, consolidating after a big move up. Celsius, like I said, this shook me out below the ADMA, just came down to the 21 and blasted off yesterday and followed through today. Uber came down to the 21 very much in the same manner, but I talked on the podcast about this. I had a better entry point, so we really never went in the red on the overall position. And this had a nice 3-day bounce off the 21. That's what you want to see. Intuitive Surgical undercut the 21 a couple times, but relative strength kicking back in, or not, sorry, price action kicking back in, relative strength just going sideways. So this is another one where the chart looks good, but the relative strength isn't necessarily supporting it. Going sideways is the least we want to see, unlike with Shopify, which we saw it pointing lower. DraftKings pulled back to the 21. Nice couple of days on a bounce off of there. Ferrari pulled back, actually undercut the 21, bounced at the 50-day, 2 nice days off of that 50-day moving average back at 300 resistance. NVIDIA continues to be the leader. 4-day consolidation this week after its earnings gap last week. Meta continues to just, what can you say about stocks that act like this? Riding the ADMA higher is a portfolio manager's dream. Microsoft, same thing, riding, excuse me, the ADMA higher, and that's your 21 over 21 list, and that's going to wrap this week's video. Reminder of why we do what we do here at Revere. It's to keep our clients out of bad, negative experiences with the market. Had to pause there, just had some company arrive, and you can see here, avoiding these bear markets. It's our number one job. When the market participates, the market bounces back. We wait till the market has our wind at our back to get back in. If you're interested in this approach, email me, don@revereasset.com, or the phone is 855-REAL-WEALTH. That's 855-732-5932. So remember, it's not how much you make in the market, it's how much of that you can keep. And with that, I will wrap up the week ending June 2nd. This is Don Vandenbord with Revere Asset, telling it like it is. Thanks for listening and have a great weekend.